Welcome to Investors Guide. Thank you so much for tuning in, and Happy New Year to you. But for us who deal with the world of investments, a new financial year is a new year. And we're going to help you through this new year find the best products and, of course, streamline your portfolio and make the best possible investments. My email ID is at the bottom of your screen right now, and so is my Twitter handle, so you can get in touch with me for any question you might have about what you hear on the show today. This week, we'll start with a portfolio of a viewer who's battling a life-threatening disease. We'll help him plan for his family. In our product review, we look at the L&T Tax Advantage Fund. We'll find out if it's gotten any better over the last year, or should we give up on it? And finally, we'll tell you if you can buy a term cover right now in spite of diabetes and a family history of lung disease. All right, let me bring in Dhirendra Kumar, the CEO of Value Research, who joins us every week and gives us advice on investing in mutual funds. Dhirendra, many thanks for joining us.
Thank you.
On Investors Guide. Let's get straight to our portfolio question. Our question this week comes in from Dr. Rajesh Gupta, who writes in from Kulu in Himachal. He tells us he's a 45-year-old floriculture scientist who has an 8-year-old daughter and lives with his wife. Now, he has a monthly income of 90,000 rupees and his wife makes an additional 25,000 rupees. Dr. Gupta is on the phone line with us right now. Tell us, what are your goals right now and what are your concerns?
My goals are, since I am a cancer patient, my life and goals both are in turbulence. But even then, I have some following goals in my mind. Education of my daughter, marriage of daughter, sufficient funds for my family so that they could live a decent life after my death, regular income for my family.
Well, Dr. Gupta, I'm going to first ask you a couple of questions, if you don't mind. I want to first ask you what your health insurance is like right now, and is your, your treatment being covered by health insurance? Is that a problem that you're having, or has that already been looked after?
Since I am a government employee, I am covered. My health insurance is covered by my employer, and I get fully reimbursed for my treatment and for my family also.
That's a good thing, and we're glad to hear about that, and our support is with you completely, and you're making a very brave decision to have gotten in touch with us for help with your finances. Dhirendra, I think the next thing we need to look at is his life cover. Obviously, at this point, it's going to be a little difficult for him to get a fresh term cover, but Dr. Rajesh, take us through your life insurance at this point. What sort of life insurance do you have?
LIC, 1 lakh rupees, GISS, 2 lakh rupees, and term insurance of rupees 10 lakh rupees.
All right, and we're going to go over the rest of your investments. From what you sent us, you have 9 lakh rupees in stocks, about 36 lakh rupees in your Provident Fund and 7 lakh rupees in your Public Provident Fund, apart from other mutual fund investments right now. Tell us what sort of fresh contributions you can make for the time being.
Since I have less time with me, I want to make some investments which can grow with leaps and bounds for my family. So I have decided to invest in mutual funds.
All right, on that, I'm going to bring in Dhirendra Kumar. Dhirendra, you've heard the case right now. So he wants to invest something that will give him strong returns. Now, given the entire case, what would you recommend he does? First of all, let's start with the money that's in stocks, PF and PPF. Now, both of the PF and the PPF will just go to the first nominee if that is the case. But what would you like him to do with the 9 lakh rupees invested in stocks?
Before getting on to any investment, it is very important that how these investments are organized. One is that have a very clear demat account jointly with your wife, so that nobody has to get into the hassle of getting ownership of this. Likewise, for mutual fund, have the person whom you would like these these investments to be passed on. They should be the second holder along with a nominee. These 7 funds combined together, I think they are excellent. They are just the kind of fund which you should be having. They have the flexibility built into them, and none of these funds have a very narrow objective except for Magnum Emerging Business. But that I also don't rule out. You should have 1 or 2 funds. You should have about 10-15% into something which is more aggressive, and particularly the kind of time frame that you have, and you want these investments to grow rapidly.
Dhirendra, I think the focus here right now is the fact that he has all of these investments. He would also like to put in an additional 1 lakh rupees every month. Could you give him a investment that he could put that 1 lakh rupees in, or would you like him to just divide it across the mutual funds that he already has?
No, dividing it, he already has these 7 funds, and of which, the Goldman Sachs CPSC is an ETF which may not be very difficult for him to even invest there regularly, but it is not a worthwhile investment to make. So I would suggest that he spreads his money over the 6 funds or the 5 funds, excluding emerging business fund from this universe. Or maybe the only fund which has been which has a relatively narrow objective is the emerging business, and that is something which is worth considering dropping from your 1 lakh allocation to be made every month.
All right, Dr. Gupta, that's the advice you're getting right now. Would you like to ask us any more questions?
No, ma'am. Thank you very much for calling.
And personally, as a gesture from me, I will be sending you a financial planner who will get in touch with you over the next week or so, who will help you organize all of your investments and make sure that all the paperwork is in place. Thank you so much for getting in touch with us.
Thank you very much for calling.
All right, let's move on to our next question. Manish Singhal has written in, Dhirendra. He wants to know if investing in the NPS right now is a better option than picking a pension fund from one of the insurance companies. Now, we know that pension funds have had quite a few changes over the last couple of years. They come with a guaranteed return now, Dhirendra. When you compare the two products, obviously the NPS is still cheaper, but would you say it's a better investment option?
Yes, absolutely. When we compare the pension plans, what matters most is the cost over a long period of time, and on that count NPS is excellent. The only problem is the rigidity of allocation, and if you're looking at for somebody very young, it might be a constraint that the maximum investment that the NPS you can have in equity by way of through NPS is 50%.
All right, and if you want to know what ELSS or tax saving mutual fund you should invest in, that's coming up a little later on the show. But first, before we go into break, like I said in the beginning of the show, it is the first portion of a financial new year, and new year comes with an opportunity to make some resolutions. Here are 5 resolutions that you could make in the new financial year to become a better money manager. Take a look.
A new financial year comes with the opportunity to be more financially responsible, and we recommend you start by making some resolutions. So here are 5 easy steps to set your portfolio in order.
Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. It's time for our product review, and this week we're looking at the L&T Tax Advantage Fund. Avan is here to give us an introduction. Avan.
Thanks for that, Faye. Our fund in focus this week is the L&T Tax Advantage Fund. A quick recap on this fund. It used to be called the Fidelity Tax Advantage until the acquisition in March 2012. We've been keeping a close eye on all these funds since the change. And let's take a look at its track record. The 2008 downturn impacted the fund's performance, and even though it managed to recover in line with the category average in 2009, the fund has had a mediocre run ever since, except for 1 year in 2010, when it beat its category by 10%. The fund is currently ranked at 49 out of 73 funds in the category. Currently, the top 3 sectors are financials, technology and FMCG. Let's bring in some numbers to get you a better outlook of the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 2,665 rupees today. So is this a good bet? Should you add this fund to your portfolio? Let's find out. With that, it's back to you, Faye.
Dhirendra, before we went into break, we talked about the fact that it's a new financial year which should ideally start with a new tax saving plan. Now, if we're going to start our tax saving in the beginning of the year, let's talk about L&T Tax Saver. Now, when it was Fidelity Tax Advantage, it didn't do as well. It was not very impressive. Has that changed since the management changed? Are you impressed at all with this fund right now?
No, I think even before the fund was acquired by the fund company, the fund house was acquired by L&T. Even before that, this fund actually started heading towards its mediocrity, and it remains one. I don't think there has been a radical change. In fact, 2010 was this fund has been disappointing relative to other options that investors have in the tax saving category. But if you look at the fund's ability to beat its benchmark, it has done every year except 2010. So the fund in an isolation, if you take a very isolated view, this fund is reasonably okay.
I'm going to pull up the funds that you recommended as equity-linked savings schemes for the year, putting that on your screen right now. My question to you is this. Investors who are in the L&T Tax Advantage Fund, if their lock-in has expired and they can actually move that money out, does it make sense to pick one of these funds instead?
Yes, absolutely. This fund, at the same time, you'll be able to recycle money into other tax-saving fund, and which will be your entitlement, which will get you the tax break for this year.
All right, finally, the last time we reviewed this fund, you gave it 3 stars. What's your star rating of the L&T Tax Advantage Fund right now?
This is a category where investors get stuck for 3 years at least anyway. But one thing impressive about this fund is that it has not changed its track. It is not a compromise on diversification. It continues to follow a bottom-up strategy. Sometimes it can, it might start doing well, but yes, I would give it again a 3-star.
3 stars there for the L&T Tax Advantage Fund. Remember, Dhirendra said there are better options for you in the market. But if your 3-year lock-in is still on, then don't worry. It's not a bad fund. It's just not the top performer. Let's take our hold or sell question. Well, Vijay has written in, he's been investing in mutual funds for the last 3 years, Dhirendra. He wants to build a retirement corpus with a time horizon of 20 years. He wants to know if his investments are on track. Well, he has quite a few large cap funds. I'm going to take them together. He has the Birla Sun Life Frontline Equity, the ICICI Focus Blue Chip Equity and HDFC Top 200, which has a mix of mid as well. Now, of these 3 funds, 20-year horizon, which of these would you like him to hold on to?
No, I would like him to hold on to HDFC Top 200 as well as Birla Sun Life Frontline Equity. I would like him to drop ICICI Prudential Focus Blue Chip Fund, not because it's a bad fund, but it's an excellent large cap fund. But if he wants to be a passive investor in a mutual fund, investing regularly, he should be in a fund which has the flexibility. If you recall, HDFC Top 200 can go, the benchmark of both the funds, Frontline Equity as well as BSE 200, as well as HDFC Top 200, the benchmark is BSE 200. It's a much broad-based thing. So they have the leeway to spread more widely. ICICI Prudential Blue Chip won't.
The next fund on his list is a slightly newer fund, Dhirendra, which is why I want to review from you. The Edelweiss Diversified Growth Equity Top 100. Does it make sense to hold on to this fund? And from what you've seen so far, are you impressed?
Yes, it's a very conservative fund and it's a fairly diversified fund, and it has done very well relative to the kind of risks that it's assuming. So one has to see it over time, but so far it has been an impressive fund, but with its conservative strategy, which might have worked in the kind of market we have seen so far in its life.
Well, the next fund on his list, I know you're going to give a thumbs up to, because this is exactly the kind of fund you recommend for someone with his time horizon. IDFC Premier Equity, Dhirendra. Continue this investment?
Yes, absolutely. This has been an impressive fund. It's not a mid-cap fund, though it is perceived as one. And it's a kind of fund, but this is a fund which is so heavily dependent on the fund manager that one has to be a little watchful, though we are, beginning to believe in its continued performance.
Well, the next on his list is the Mirae Asset India Opportunities, Dhirendra. Continue that investment as well?
I thought that, initially it was just, was able to hit upon some stocks which has boosted its performance. But now I find that it has done well consistently. The portfolio reflects thought. At the same time, it has kept away from a low quality portfolio, which has come in very handy. And I find that the approach or the consistency of approach in this fund has driven this performance, and that should prevail.
Well, the next 2 funds on his list, Dhirendra, the Kotak Gold and Reliance Pharma, does it make sense really to have both of these funds with a 20-year horizon?
No, for a 20-year time frame, he can do without these. And the kind of fund he has chosen, that will take care of all of it. He should avoid investing in these funds, at the same time consider liquidating whatever he has accumulated so far.
Well, the last fund on the list is the ICICI Prudential Balanced Fund, Dhirendra. He has 2,000 rupees going in to this fund every month. Now, given the fact that he has a 20-year horizon, does it make sense to use this as the debt exposure that he needs?
No, I would like him to drop that fund as well. And he should approach his fixed income allocation in a very deliberate way.
All right, so on your screen right now is what Dhirendra recommends you hold on to, and of course you can write back to us if you have any more questions. If you would like us to take a look at your entire list of mutual funds, write to us. Email ID is on your screen right now. Last question, Sudhakar has written in, Dhirendra, low risk appetite, salaried professional. He wants to know what is the safest possible investment option for him. Is it a fixed deposit or is there a better way to get returns? Now, we have talked about the fact that debt funds give better returns than a fixed deposit, but a big learning over the last 1 year has been that there is risk involved even in a debt fund. So would you say then, if I'm looking for an absolutely safe way to do it, that a fixed deposit is the way to go?
No, not really. Yes, last year has been disappointing. Fixed income funds can be risky. They can go down in value over a brief period of time, but you still have a segment of fixed income fund which can give you a little superior return than fixed deposit, and it will certainly be more tax efficient. I would say that liquid funds, ultra short-term bond funds will continue to deliver superior return than fixed deposit on a tax-adjusted basis and with far higher liquidity. And of course, if you are looking at the only difference between a fixed deposit and a liquid fund is that there you are guaranteed you get a guaranteed return. Here you don't get, but you can reasonably estimate what kind of return you are likely to get from a liquid fund today.
So Dhirendra, I'm going to ask you to stick your neck out a little bit. Reasonably estimate for us what return we are likely to get from a liquid fund today if we put our money in right now, given where the interest rate cycle is.
I would say that it will be safe to expect about 8.5%, 8.5 to 9%, and the other big advantage which you get here is 8.5 to 9% and money on call anytime.
That's true, that you can take your money out at any point. That's the difference between a fixed deposit and a liquid fund or an ultra short-term fund. And of course, they're very different in terms of the tax treatment as well. That's something you should take into consideration when you're making your choices. Dhirendra, thank you so much for answering our questions this week. We look forward to having you back again next week. Coming up after the break, we will tell you if you should buy a term cover and how to buy a term cover if you're diabetic and have a family history of cancer. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. We've brought in Anil Sehgal this week to answer questions on insurance. Anil, thank you for joining us.
Thank you.
Well, Anindya Roy has written in. He's 37 years old and he would like to buy a term insurance policy. Now, that might seem simple enough, although he's written in saying that he's suffering from diabetes right now. He also smokes occasionally. He has a family history of lung cancer and heart ailment. Now, Anindya, thank you for getting in touch with us, and it's better sooner than later that you get that term insurance policy. The good news is that Anindya already has a health insurance plan, so that's taken care of. Let's look at his life insurance. Now, Anil, obviously he still can get a policy, although it might be a little more expensive than a regular plan. How can he go about doing it?
Anindya, the fact that you have a medical history with diabetes and a family history which includes heart ailment and lung cancer makes the matter slightly more complicated. It's not necessary that an insurance company, on considering these, will decline you. It may result, however, in a rating up of your insurance premiums. So it's not a necessary decline, and the way to do it is to apply for the life insurance and answer all the details. The insurer might ask you to undertake additional tests which will help them to determine what to do in terms of accepting your risk. So that's what I would recommend to you. Now, you can apply for any term plan, whether it is online or offline, but not for a plan which is a non-medical plan. So any medically underwritten plan you can apply for.
All right, Anindya, if you have any trouble getting that term plan, get back in touch with us and we'll try and help you through it. Our next question comes in from Satish, who writes in saying he works for a private bank and he'd like to buy a health policy for his entire family. He's trying to choose between the various options available to him in the market: Max, Bupa, L&T, Religare, HDFC, ICICI. A lot of our viewers write in with the same question. Now, his criteria is he wants a reimbursement facility in case he goes to a hospital that's not part of the network. He also wants to cover his family for 3 lakh rupees and he wants an additional cover of 5 lakh rupees. Of all of these options, Anil, which one would you recommend for him?
Satish, basically you want to cover 3 adults, which is yourself, your brother and your mother. Now typically family floater plans will only cover maximum of 2 adults. So you have 2 options really. You can look at the Max Bupa Family First plan, or you can look at taking 3 individual plans. Now 3 individual plans may work out better because ultimately you might want to also get married and have additional cover for your other family members who might be there. So individual plans could be an option, or you could look at a Max Bupa Family First. Now as far as reimbursements are concerned, now if you go for treatment in any non-network hospital for any of the insurance companies, typically the medical bills will have to be on reimbursement basis, and reimbursement is typically available, so that's not a problem, subject to obviously the guidelines. As far as which plan is concerned, I would suggest once you have decided whether you want to go for a family float or individual plans, and once you know what is the sum assured that you seek, compare the plans because the prices can be fairly different, and then decide based on your exact requirements.
All right, Anil, thank you so much for answering our questions on Investor's Guide this week. If you have a question about your insurance policy or any other investment, write to us. Our email ID is on your screen right now. You can reach me personally on Twitter as well. It'll be my pleasure to hear from you. Thanks so much for watching.